Welcome to the Simply Financial podcast. I'm your host, Christopher Calandra. I wanted to provide you with an overview of permanent life insurance. And to be candid, I want to say that this episode has been planned for a while, but I've had difficulty getting enthused and ready to talk about this. And the reason is, which is another way for me to be upfront with all of you, is that I am biased against permanent life insurance. I am biased in favor of term insurance, which is something that I covered in last week's episode of the Simply Financial podcast. To be clear, I only own term insurance on myself. In my practice here at Elliott Wealth Management Services, helping our clients win with money as we plan together, I almost always use term insurance. There have been a few instances over the last bunch of years where I use permanent life insurance because my view is that it should be term insurance unless there is a clear and overriding reason for it not to be term insurance. And those reasons do exist out there, but they're fewer and far between and kind of specialized. So let's talk about what permanent life insurance is. Permanent life insurance covers you for the rest of your life. When you're underwritten for permanent life insurance, the insurance company will give you a premium, and they're calculating that premium and that death benefit with the idea that you are going to have this coverage for the rest of your life. This is in stark contrast to term insurance, which has a term, 10 years, 15 years, 20 years, and so on. So the pricing is only over that specific term period. Permanent life insurance is not like that. Permanent life insurance is more expensive than term insurance by quite a bit. Could be 10, 20 times more expensive. So for $1 of insurance premium, you're typically going to get less life insurance coverage. Now that gap can narrow as you get older. Term insurance becomes less attractive, less appealing. So permanent life insurance, it's built so that you pay a premium, you're going to have coverage through your whole life. It is more expensive than term insurance. Thus, my bias towards the less expensive solution to providing life insurance protection for loved ones and those counting on your income. Another key element of permanent life insurance, and it's part of the reason why permanent life insurance tends to be much more expensive than term insurance, is because it has a savings account or a cash value accumulation feature inside the policy. So in term insurance, you pay a premium, you get the life insurance protection. That's it. It's the end of the story. The only way you get a payout is if you pass away. With permanent life insurance, there's a different element that's included. Some of your premium can and often will go to some type of savings account. The way you get interest can be different depending on the type of permanent insurance, because as we'll talk about in a moment, there's a whole bunch of different types. But permanent life insurance is noted for this savings account cash value accumulation. And some people find appeal with that because some of your premium goes to cover the cost of the death benefit, and some of the premium goes to build up cash accumulation. And that cash accumulation can be a supplemental retirement account, can be used to fund college, it can be borrowed against. If you find out later that you don't need insurance, you could take the cash out. But one of the negatives is that in the early years of most permanent life insurance policies, and I stress most, there's all kinds of different stuff out there. I'm talking in generalities. It takes a while for the savings account, the cash value account, to build up. A lot of the costs in these policies, the insurance company costs, are front loaded. So you might pay into a policy for 3, 5, 7 years and not accumulate much, if any, cash value if you were to surrender the policy. But it is a feature, And in certain instances, that feature can be very positive. Although, as I said at the top of the show, I find those instances to be few and far between. They do exist, though. There are several types of permanent life insurance policies, and complicating matters is that the marketing folks at these life insurance companies have come up with countless ways to name the policies. I wanted to cover some of the major ones, though, with you to kind of give you a little bit of a flavor. Whole life insurance has been around the longest, and the whole, WHOLE, describes exactly what it is. You are underwritten. They make an offer of insurance. You pay a premium. You get a death benefit. Almost always, if you pay that premium, you'll have that life insurance coverage as long as you live, and you could carry that deep into your life expectancy. It builds up cash value. There's ways that you could get interest. It could be dividends. It could be interest. You will build up cash value over time. As I just mentioned, have low expectations in the early years. There's quite a debate in the industry about how attractive the interest rates are in whole life. A lot of the historical illustrations that you can be shown look, I think, better than what they actually are because we are in a 0% interest rate environment. So some of the long-term illustrations, 10, 20, 30 years, if you back test, include periods when you would get way more interest than you do today in the bank. And that has a corresponding effect on the cash buildup in whole life policies. The savings component in whole life policies is much more like a bank account than an investment. What developed after whole life was something called universal life, and I believe that the birth of this policy type was during a period when we had very high interest rates. So it's more interest rate sensitive, or tends to be more interest rate sensitive than whole life. Universal life is also more flexible. You typically have more flexible in the premium you paid, which is different than whole life, which is static. So you have your premium is a little more flexible. Your death benefit could be flexible. And the way your interest is calculated in your internal savings account is also a little more flexible. And the interest does rise and fall more in conjunction with what interest rates are doing in the economy. Universal life used to be more popular years ago when interest rates were higher. What's evolved now is a evolution of universal life called index universal life. I haven't done any of this, by the way, with my clients in my practice in Elliott Wealth Management. I'm not saying it's automatically bad, but I am saying that I shy away from it and have not used it at all. Index universal life, the cash component that we just spoke about, the interest that you get credited is based on some measurement, some formula associated with the performance of an index, like the S&P 500 or Dow Jones Industrial Average. And the idea is that the interest you get credited will benefit from the long-term performance of the stock market, which historically has been very good. The index universal life, though, that crediting mechanism for interest provides usually downside protection where you can't do worse than 0%. So you could share in the upside, but not share in the downside. A few problems with the index universal life. First off, it's permanent life insurance, which I generally view as a negative. They're complicated. There's a lot of moving parts. You could manipulate illustrations. The salespeople from the insurance companies have a lot of ability to customize an illustration, which can lead, in the wrong hands with an unscrupulous agent, to showing some illustrations, some interest crediting that will fall under the category of too good to be true, in my opinion. Moving along, the third major component after whole life insurance and universal life and its cousin index universal life is variable life. What is key about variable life is that the savings account component, the cash value component, is invested in mutual fund-like investment accounts. So you have access to the stock and the bond market. It's the one version of permanent life insurance where your cash value is typically not guaranteed against loss, because when you're investing in mutual fund-like stock and bond accounts, they are susceptible to periods of negative performance. And there is different types of variable life. There's variable universal life, so that again falls into these different niches and names that they're called for marketing purposes. But we have whole life, universal life, and variable life. As I said at the beginning, these are not automatically bad products in and of themselves. I think that they are oversold in the marketplace. I think the vast majority of situations call for term insurance. I already shared with you that's the only thing that I own in my own household, and it's been this way for a very long time. But at older ages, dealing with estate planning, dealing with long-term care protection, those are 3 examples where permanent life insurance can and does make sense. And when I have used permanent insurance over the last couple of years, they've fallen into this category. A quick example, what's evolved in the marketplace because of reasons associated with the long-term care insurance market is you can get permanent insurance policies where you have a death benefit. Let's say it's $500,000 to use an example. That if you pass away, your heirs will get the $500,000. But if you need long-term care, you can access the $500,000 during your lifetime to cover the cost of your long-term care insurance expenses. And this is attractive. It's not a silver bullet, but it has a lot of attractive elements to it. And when I think of permanent insurance, and I think what's the most likely way that I would use it over the next 12 months in planning for my clients to be successful financially, I think that's the most common one. So permanent life insurance continues to evolve. The country, the demographics, the marketplace continues to change. And so permanent life insurance is changing along with it. But once again, I know I'm repeating myself. I prefer term insurance in the vast majority of instances, but there are places where permanent life insurance can and does work. And I am agnostic in working with clients. If it makes sense to do permanent life insurance, if that's the right tool for the job we're trying to get accomplished, I'm all in favor of it. But most times, term insurance is going to be the right tool. Thank you so much for listening today. I hope you found this helpful. I will ask, like I normally do, please subscribe to the podcast and tell a friend, family member, coworker to check it out. I'd really appreciate that. And I will be back with you on the next episode of the Simply Financial podcast very soon. Thanks for listening today.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.